Hey everybody, welcome to Trading Capital. I'm your head trader here, Curtis Scouten, and it is currently June 15th. Lots to discuss in today's market action. We had the long-awaited Fed interest rate policy decision, as well as some guidance and GDP and economic data forecasts. So it was a pretty important day to analyze as a whole. A lot has transpired. Lots will probably continue to transpire this week, especially since this week is also Friday Options X, where it's a quad witching hour where 4 different asset classes will expire, and essentially trillions of dollars is exchanging hands in the options market. Most of that money, of course, flowing to institutions. But nonetheless, we're going to discuss the S&P 500, interest rates, the Federal Reserve's comments, oil, natural gas, gold, the Nasdaq, and Bitcoin as well. So let's dive right into the S&P 500. Overall, it was a pretty positive day for the market. So we were expecting some sort of a relief rally. The reason being is on a historical basis, when you first look at heading into an FOMC meeting, the markets really never crash or sell off sharply. They always tend to have a more positive, favorable upside move. So there's that. Point 2 is the markets always are forward looking and price in the worst case scenario. So most of the market was expecting a 0.75% hike, especially after a couple days ago from Federal Reserve member comments. They kind of showcased that they were going to raise it 0.75 of a basis point, and that's what they did. And so that shouldn't have been a shock, especially since the fact that US 10-year yields were up drastically heading into the meeting. So the market's always priced in that worst case scenario, and the fact that now we didn't get, say, a 1% hike, and that Jay Powell was pretty calm in terms of discussing the economic data, as he usually is. That's typically how a lawyer is. They're good at deflecting questions and beating around the bush and not really giving you direct critical thinking answers. And in many ways, I just wish they would rip the Band-Aid off and give the markets what they want. But we'll just have to, as they say, rely on the data and watch and wait for the data. They seem to really rely on the data, but all the data they're looking at are all lagging indicators versus the data that we analyze here at Trading Capital is leading indicators. But nonetheless, yields have dropped on the back of an interest rate hike, kind of that counterintuitive move that often happens in the markets. You cannot be going with what you generally think is going to happen. You would expect with an interest rate hike, rates would continue to move up. But that is generally not the case because, like I said, markets always price in the worst case scenario. So I believe that this drop of 5% in rates, and it was actually up on the day, so I think it's a 7-8% reversal on interest rates, should provide some sort of relief for the tech play. And I think with the bullish chart setups, especially on the S&P 500, that we'll go over, and many other low, mid-cap, large-cap tech stocks are actually looking very, very bullish in the short term to potentially ride that move higher. And that's why we actually picked up a few extra longs, and we did close one today, but we, over the last couple of days, we've closed a few shorts. We've picked up some longs, some beaten down names. We still have an overall, basically a very 50-50 mix of long and shorts on the market, but we're primed to benefit from those ones that are way too overvalued in the short term. So let's jump into the SPY. Overall, it was a positive day, finishing up 1.43%. So this is the 30-minute chart. And you can notice here was your pre-market action where you started floating up, floating up, floating up. And all day you created this bullish consolidation channel where you made a high, you made a low, you made another, you came up to test the top of this resistance band. And then the data started being released, where we had the forecast, SEP reports, GDP numbers, etc., etc. And essentially, we had this whipsaw price action. This candle canceled each other out because it closed down here at 374, which was now looking to break this bullish consolidation, but you did not confirm. You started going lower, but then you reversed all the way up, had a big spike move up, and then closed down here. And then your second candle over here was extremely bullish and had a rip-roaring rally. We managed to pull off a day trade in the live day trade room, and then you had a reversal back into your support. So you are closing above that previous resistance trend line that you were consolidating in all day. So on a short-term bias, I do favor a potential move up. And it's not a good inverse head and shoulders. I've definitely seen cleaner ones, but you could definitely argue that you have a potential inverse head and shoulders here forming. Now, the only reason I don't like this pattern as much is because you had this wild whipsaw price action. And it does kind of cancel each other out when you go over the candle formation, but at the end of the day, you are closing above this red trend line here that was keeping you intact for the majority of the move, the afternoon session leading up to the FOMC meeting. So we'll just have to continue to monitor that. Let's just say this pattern does break out. You could potentially be looking at a move of, say, all the way up. I think it's priced out to your gap fill zone. So that would definitely coincide with filling that technical gap. It's just shy of that technical gap, but in all honesty, a move to the high range of that gap would be the likely scenario if this pattern was to break up and continue some bullish momentum. So essentially tomorrow, what I'm going to be looking for is, if we flip to the 10-minute chart or the hourly chart, since we can clean it up, we want to see some bullish consolidation, more or less along this potential neckline here. But if we remove the neckline and don't rely on that, you can just rely on this potential bullish formation over here. You want to see consolidation in the upper range and then start breaking out above and chasing this gap. So there is a likely scenario that the S&P does get a bounce along with many of the tech due to the fact that yields have fallen substantially. The QQQ on the daily chart, it did finish green on the day as well, up over 2.5%. You can clearly see that it was trying to chase this gap fill over here, pushed up, and then it had a late day reversal into the end of the day. So we'll just have to continue on that. I do think you at least get a minimum gap fill here around the 288, and then potentially looking for this 299 gap fill, which would be your next major resistance. And in all honesty, these markets don't really have much conviction anymore. You know, we're waiting for short squeezes, we're waiting for this, but it seems that the overall bias is certainly favoring the downside, and that's certainly what the put to call ratio is demonstrating as well. Let's take a look at oil. Oil's very interesting. Down day on oil, it's good to see because what the interesting thing is that the whole media has been extremely bullish on oil, and overall, I'm just not buying it. You know, demand destruction does start to occur when oil is trading above $100 a barrel for 4 months, and come the end of this week, oil will have been trading above $100 a barrel for 4 months, and that's essentially when the GFC crisis started, was when oil in 2008 completely killed the economy and drained consumers via inflationary energy prices, and it was roughly 4 months above $100 a barrel, and that was the breaking point. So we're approaching these same metrics that line up to many different aspects of cycles that we've been through, and that's why I love cycle analysis. But daily chart, down day on oil, good to see we are short oil, and don't be surprised, I think there's going to be potentially a big drop in oil here. And today was interesting because the EIA released a survey or a report saying that oil demand is expected to uptick in the remainder of 2022 and continue to grow in 2023. And frankly, I just don't see that, because if we're heading into a recession, which is all the data I'm looking at is pointing to that in all the previous cycles, and considering this is one of the worst declines for risk on and risk off assets simultaneously, something that we've really never experienced in a 50-year trend, this scenario is no different. Yes, there is a supply constraint due to horrific energy policies from certain political parties. But at the end of the day, the demand trumps everything, in my opinion, because the one thing that the Fed can kill is demand through the removal of their artificial liquidity, which kicks up demand. So, if they can certainly create demand with low interest rates and artificial liquidity, they can certainly kill it with higher rates and QT. So, and the interesting thing, Jerome Powell kind of dodged QT in his FOMC meeting. So we'll just have to continue to monitor that. Are they really serious? We'll have to monitor the balance sheet. That's going to be a certain one that we'll have to continue. But he was touching on housing. He did say housing softening a couple times. And that's certainly his trigger words over the past, even in the 2018 initial Powell pivot. He likes using certain adjectives that definitely mean and carry a little bit more weight. So it's interesting to note the language that he uses and the changes over time, just due to the fact that how the economy is doing. But if we look at oil on a weekly basis and why I think a big drop is coming, that could potentially happen this week and catch a lot of people off guard, because we have the overall sentiment for oil remaining in a major bullish uptrend. If you really analyze it on a weekly basis, you had this initial move up, which was the Russia invasion. And when you actually think about it, the initial invasion, was the worst. It was the peak fear, and the markets obviously got used to that fear. But now that several weeks have passed, basically the peak was here in beginning of March, and we're looking at mid-June. So the peak fear has passed, and arguably the supply chains due to the war have gotten worse when you compare this period, and the overall impact of the war has gotten a lot worse for everyone, Russia included, and North America and Europe. So in a way, if the scenarios for oil have technically gotten more bullish because the conditions are getting worse, you would think oil would have taken out this high a long time ago, especially since now you've had media pump it up, retail pump it up. So the fact that you're still inside bar, this bearish decline, this massive drop, is certainly a short-term indicator when you actually break it down that the conditions, the financial sanctions, 6 rounds of sanctions, there were 0 sanctions over here, and there's now 6 rounds of sanctions here. So you can argue that the conditions are primed for a better fundamental backdrop for oil right now, but why isn't the price higher? So this is where you have to now analyze the economy and really try to stay objective. Demand supersedes everything. Yes, there is a supply crunch in oil. I do think that's a serious investment opportunity that trading capital will capitalize. But after this economic bust cycle, this recessionary cycle, this declining cycle, then once the Fed pivots and starts to print again, then I do think oil and energies will be a good value play to accumulate for that inevitable wreckage of bad energy policies by our politicians. But if we look on a weekly basis, this was the breakout candle on a weekly close. You had the highest weekly close since the invasion. So around 120 on the WTI US oil chart. So you had the highest weekly close on this candle since the invasion, which signified the start of a potential breakout. What you wanted to see was continued move up to confirm above. You did not get that. You actually got a doji candle, which is bearish, saying that even though the price is so bullish, the buyers were met with equal selling. So you had this bearish candle, and then you got confirmation that again to the downside is proving to be a little bit stronger now, because you did rally up but failed to hold that, and now you've engulfed the previous high candle close. So you did not get confirmation, and now you've pretty much failed at this breakout. So it does stand to suggest whenever you've been stuck in a range on a technical basis, don't be surprised if oil has a sudden drop to the low range of this range, piercing or potentially around the $100 or piercing $100 and heading to 95 here. Actually, let's go with the weekly close. The weekly close is going to be the most powerful. So you have 2 candles over here that signifies your channel. So that will be the most, which is roughly around 97. That would hold the most technical weight. So don't be surprised if we see a sudden drop down to this 97 a barrel. And that should coincide with the new forecast that we got in GDP forecast is now been revised down to 0%. If they're putting GDP forecast for Q2 2022 at 0%, it's contracting. And when we find out the hard numbers, I believe it's July 15th, so still a little bit away, we will meet that technical recession. There are so many economists that only think we're heading into recession in Q1 or Q2 of 2023 or even Q4 of 2023. I find that hard to believe. I do think the recession is coming faster than people think, and that's because of the high frequency of our markets. Things happen at such a faster, blistering rate due to the fact of technology and obviously innovation. But and the overall news, how fast things spread these days. So I do think we are on an expedited process where energies are going to collapse. It's interesting because we are in a bear market. Even after today, we could be classified, in my opinion, it's classified as a bear market. And energies is the last positive sector on the year to be holding. So that inevitably changes it's very rare for a sector to be able to hold the only positive sector in the indices throughout the year when the rest of them are negative. It is an astonishing, and it's never been done if you look at past cycles. There's always a couple or one last leading sector, and then in a bear market, the bear gets all sectors. That's what we have to remember. It's not overcomplicating it. Human nature is the same. We have had supply chain issues. We have had shortages. We have had sanctions just on different countries, arguably, just as bad due to the output. But people tend to overthink and get sucked into the Kool-Aid of saying oil is going to $200 a barrel this cycle. I find that very difficult to believe. If we look at the monthly chart on oil, we still have to remember this. So you're still on this 1, 2, 3, 4, 5, 6, 7 months of straight upside in oil after this initial power move. And the interesting thing about this monthly chart is you have your high, you have your low in 2008, and look, you have your cycle high here, which I believe after this big reversal, this can be classified as a monthly topping tail. And then you've had all this inside bar bearish consolidation, waiting for a classic decline to break down. So oil is just very, very intriguing because you do have your bottom here, and this is a fully measured move on a monthly basis when you compare this to this. It's an exact identical move. Exact identical. That's the power of trend lines and the power of parallel trend lines. Human nature loves symmetry, and that's part of human nature's behaviors. Like symmetry is one of the most appealing things to humans, and it's really ironic how this parallel channels work out. But overall, let's see if we get that downside. Discussing natural gas is really done, despite it being up on the day, a pretty decent move, 3.5%. It's still bearishly consolidating in this lower range to potentially break lower. Now, you did have a little bit of a move in the early to morning parts, but overall, as the day went on, natural gas put in this beautiful hourly intraday topping tail, and you just saw downside since. And one of the reasons natural gas is struggling in and around this area, if I just show you this trend line over here, look at that trend line. So you have your pivot to your pivot, connects through your impulse move down, and then you have all this chop. You broke out above, made a new high, reversed back in, made your intraday topping tail, confirmed down below, rallied back up, trying to break above, failed to break down, reversed, fell a lot lower, tested the short-term moving average again, broke up again, tested, pulled off, broke up again, tried cleaning through this trend line over here, and now you're looking to close below again. Obviously, there's still 35 minutes left in this candle, but if you look at it on a daily chart, natural gas is certainly struggling at that resistance point, and it's just a very interesting thing to note. But I do believe we could potentially get some sort of a bearish consolidation of this nature, where you consolidate in a little bit of an up range for potentially your next move down. 650, you'll get a bounce, but the fact that we're now consolidating above that, 650 is not going to be as powerful as we think, because if we get this bear flag pattern, a fully measured move of this size of this candle with a nice consolidation and a move lower would probably take us more so to this level down here, this 616 level. So ultimately, I do think natural gas goes a lot lower, and we'll just have to be patient with that. But ultimately, when do you think I could see natural gas moving lower? It really depends on options X. There's still a lot of bullish underlying people in natural gas that may be trying to buy the dip, and it's being met with sellers. So we'll just have to keep monitoring it. But natural gas could fall all the way to this 560, on this upsloping trend line. So you have this parallel channel where it marks your pivot highs over here to your 3 pivot highs over here, and then your pivots over here, which is your support zone. So this is arguably going to be your next biggest support zone on this lower boundary parallel range. So we'll just have to monitor natural gas in that sense and see if it breaks down, which I'm favoring. But if we go to a monthly chart, which is a really cool chart, So what I want to show you is the monthly chart on natural gas. And the monthly chart is just very, very fascinating in my opinion, because when you pull up this long-term time frame, and the monthly chart means every candle here is 1 month of data. So it's an ultra long-term view and analysis of natural gas. So looking at natural gas, you have this clear parallel channel connecting your pivot here in late 2005, your pivot high cycle here in 2008, and look at what you just hit now. Your pivot over here, and that is just something incredible to watch. And obviously there's still 15 days left in the month, so we haven't got a clear indication where this candle is going to be forming and closing. And then when you look at the bottom, you have your pivot zone here, which was your cycle start of this massive move. You have another pivot zone here, another cycle low over here, and then essentially I don't think you're going to fall down to the low range of this channel, just due to the fact that would mean you would go negative, but the technicals in a way are implying that this is a 20-year downtrend in natural gas, and ultimately it could eventually, you know, we saw oil go negative. People think it's incredible to, you know, say natural gas could go negative. Well, if oil can go negative, natural gas can go negative. Any energy could go negative if oil goes negative. It's just as simple as that. But I'm not going to put my money on negative natural gas. I wouldn't be in the trade. My max downside would be to these major pivot lows down here around 150 mark. If for some reason, you know, something collapsed, you know, I don't know what the catalyst would be to get natural gas down there, and I probably wouldn't even be in a trade shorting that down there. If it went down there, I'd probably be looking to go long. But the technicals just point that the power of this symmetry, pivot to pivot to pivot, does favor that we have a potential cycle top. So the next 2 weeks for natural gas, seeing how this monthly candle closes. Right now it is a monthly topping tail, a beautiful one I might add. And if it stays like that, if it closes anywhere inside of this candle over here, that would be a beautiful, beautiful, highly probable sell signal that the definite top is in. So another 2 weeks on natural gas will be a pretty important data technical point. That's it for today. We will discuss gold, Bitcoin, the dollar, and a few of the other plays that we did today in the next video. I'll make a secondary video later tonight, but this is all the time I have. So thank you all for being members and subscribers. Please give a like or a comment down below, and take care. Enjoy the rest of your evening.